You think you're building wealth, but you're not watching the leak. Every click, every rebalance, every smart move might be quietly bleeding you dry. Not because you're wrong, because the system is counting on your psychology. You don't need more information. You need to see where you're being emotionally baited and financially punished. By the time you notice, it's already cost you more than you'll admit. You think holding cash is playing it safe. It's not. It's playing not to lose, and that's exactly how you lose the most. Because every dollar you keep still is a dollar that's quietly bleeding. Inflation doesn't take it all at once. It starves your future slowly. In 2023, cash earned around 5%. The market, over 26%. That gap isn't small. It's devastating. You didn't wait on the sidelines. You paid $10,500 for the illusion of safety and got nothing in return. This is the blind spot. Zero market risk doesn't mean zero cost. It means guaranteed erosion. Now imagine doing that for 10 years. Not only do you miss compounding, you fall behind your own retirement. Your future shrinks month after month. While you feel like you're being careful, that's the trap. Loss aversion feels smart, but inaction is a decision too, and it's usually the most expensive one. Cash doesn't crash, but it also doesn't grow, and the world around you does. So what do you really want? Peace now or power later? Set aside your emergency fund. Yes, keep your short-term cash. But if your long-term money isn't in the market, you're not saving. You're surrendering. You followed the rules. You made money, and still lost thousands. Not to the market, to taxes you never planned for. You didn't sell at the wrong time. You sold in the wrong account. You didn't lose on the trade. You lost in translation between gains and what you actually get to keep. Every year, the IRS takes a silent bite. Not just from what you earn, from what you could have compounded. A $50,000 profit sounds great, until a 35% tax hits you for $17,500. All because you sold early, or held the wrong fund in the wrong place. And the scariest part? You never feel it. It's invisible. It just means less growth, less future, less freedom, and you don't know why. One couple saved $8,200 a year just by rearranging their assets. Not investing more, just placing them better. This is called asset location. And it could be the difference between retiring free or retiring afraid. Your Roth, that's where tax-inefficient stuff belongs. Your brokerage, that's for what grows clean. Hold long, delay gains, harvest losses, shield what bleeds. Taxes aren't a surprise. They're a trap that only works if you don't look. So ask yourself, how much are you really keeping? You think more trades mean more control. They don't. They just mean more chances to get it wrong. You're not investing. You're reacting. You're mistaking movement for mastery and bleeding for it quietly. Every trade feels like power. But what if it's just ego dressed up in data? One study tracked 66,000 investors. The most active ones underperformed the market by 6%. Not because they picked bad stocks, because they couldn't sit still. And the penalty? Half the wealth. Gone not from a crash, but from compulsive clicking. Dalbar found the average investor earned just 7.1% annually. The market returned 10.7%. That gap? Pure behavior. Fear, greed, impulse, wearing a suit and logging in again. It's not the market that robbed you. It's the need to feel smart all the time. $100,000 growing at 8% becomes $466,000 in 20 years. But at 5%, it's $265,000. Same person, same money, different mindset. Overtrading doesn't just cost you returns. It costs you peace. It turns patience into performance anxiety. And the most brutal part? Doing nothing is the thing that works. But it's the one thing your brain resists. So next time you feel the urge to trade, ask yourself, is this strategy or is this insecurity? You thought you escaped the crash, but you also escaped the recovery. And that's how the market punishes fear. It rewards those who stayed through the pain. You didn't time it wrong. You trusted your feelings. And they lied. You pulled out when the news turned red. Waited for the right moment to feel safe again. But by the time you felt safe, the rebound was already gone. In 2020, some investors sold at the bottom. $100,000 turned into $70,000 overnight. They went to cash, watched, waited. By August, the market had sprinted up 30%. They missed it. Their safe decision cost them $20,000. And that's the rule. The biggest gains often come right after the biggest drops. Miss just 10 of the best days over 40 years, and you lose half your total return. A $10,000 investment becomes $1 million if you stay in. Miss 10 days? $463,000. Miss 20? $268,000. You don't need to crash to lose everything. You just need to miss the bounce. And no one, not even the pros, knows when it's coming. So ask yourself, are you investing for growth or for emotional relief? Because waiting for the right time isn't strategy. It's surrender. Time in the market isn't just smarter. It's survival. You didn't invest. You bet on a single outcome and called it conviction. Too much in one stock, one sector, one story you believed too much for too long. Maybe it was your company. Maybe it was a tech rocket you knew would never fall. Or maybe it started balanced, but you never rebalanced. And now one thing silently dominates your portfolio, not because it's safe, but because it grew fast, until it didn't. In 2022, Meta dropped 73%. The market, down 25%. That's not volatility. That's concentration trauma. Imagine this. You have $100,000. You put half in one stock. It tanks 70%. That's $35,000 gone. The rest of your portfolio? Down maybe 20%. Total portfolio? $65,000. But if you'd capped that position at 10%, your loss would have been $7,000. Not a life-altering mistake. This isn't theory. It's Enron. It's Lehman. It's employees who watched their entire retirement evaporate because they trusted one name too much. Diversification isn't exciting, but neither is financial ruin. It's not about spreading risk. It's about removing your ego from the equation. Because the minute one investment becomes your identity, it owns you. You didn't lose your money in a crash. You lost it in decimals, tiny percentages, hidden fees, siphoned slowly year after year, and you never saw it go. You thought 1% was nothing, just cost of doing business. But over 30 years, that 1% fee could wipe out a quarter of your retirement. You didn't pay for advice. You paid for someone else's lifestyle. Two people invest $100,000. Same return. One pays no fees. The other pays 1%. After 30 years, one has $1.1 million. The other, $760,000. That's $340,000 gone to someone else's vacation home. The worst part? You never felt it leave, because fees don't scream. They whisper and compound like losses you never recover. Maybe you're paying $1,000 a year on an active fund, or $5,000 a year to a broker who manages your $500,000. Over 20 years, you're down tens of thousands. Not because the market punished you, but because you let someone else skim your future. And the industry, they package it in friendly terms. Just 0.5%. Only $5 a month. But every fee is a guaranteed hit, unlike returns which are never promised. The truth? You didn't invest in your own growth. You funded theirs. You earned the money, but then you left it behind, unreinvested, uncompounded, and used. Dividends weren't meant to be a payout. They were a multiplier, a secret engine most investors never activate. You saw the cash hit your account and thought, nice, but nice doesn't build wealth. And over time, that passive comfort becomes active regret. From 1990 to 2022, $100,000 in the S&P 500 grew to $1.1 million. But if you reinvested dividends, $2.1 million. That's $1 million difference from a box you didn't check. Reinvesting isn't flashy. It's not fun. But it's the closest thing to financial gravity we have. Dividends buying more shares. Those shares paying more dividends. Again, and again, and again. From 1928 to 2022, $1 became $216 without reinvested dividends. With reinvestment, $7,500. Same investment, different mindset. One built momentum, the other stayed flat. This isn't about income. It's about inertia, and whether your money sits still or multiplies in silence. So if you're not spending those dividends, don't let them sit. Don't let them die in cash. Make them work, or lose the fortune they were supposed to become. You didn't panic. You pre-programmed your panic, and the market used it against you. That's what a stop-loss does. It sells the moment you feel fear, even if the fear was just a flicker. You set the line at 10%. The dip hits 11. You're out. 2 weeks later, it rebounds 30%. But you're not in it anymore. You didn't avoid the loss. You locked it in. You missed the win, and it all felt safe. But safety without context is just surrender. Because a stop-loss doesn't ask why the price dropped. It doesn't know if the story changed. It just executes. Flash crash 2010. The Dow plummeted and rebounded within minutes. Thousands of stop-losses triggered. People sold at the bottom, then watched their stocks rebound without them. That's not risk management. That's an automated exit from your own conviction. Volatile stocks swing. A 5% dip is normal. But you set your trigger too tight, and now you're out of a position that didn't fail. You just couldn't ride the noise. You thought you built a parachute, but it was an ejection seat. So if you're going long-term, ask yourself, are you protecting your downside or timing your own regret? You didn't need to beat the market. You just needed to stop beating yourself. You lost more to cash than to crashes. You gave more to taxes than to time. You traded too often, trusted too much, and forgot the one thing that actually builds wealth. Stillness. Most investors don't fail from bad picks. They fail from blind spots they never saw coming. Fees, timing, overconfidence, little leaks in a boat that looked seaworthy, until it sank. But here's the truth no one wants to admit. The damage? It was preventable. All of it. Because these aren't market risks. They're human ones. And the good news? They're yours to control. Every time you stay invested, you fight fear. Every time you reinvest, you reward your future. Every time you simplify, rebalance, ignore the noise, you break the cycle. Not just for one trade, but for decades. This is the game most people lose. Not because they didn't know what to do, but because they didn't do it long enough. So now you know. The next $100,000 of mistakes is optional.